Let's review another case study. This time we've got a non-performing junior lien that we sold to an investor in the secondary mortgage market. So let's go over the specifics here. This was a single family residential property with a current senior lien in front of our junior with full equity coverage of our second position note. And looking at the numbers here, the FMV or fair market value of the property was $140,000 minus the senior UPB of $98,000 leaves us $42,000 of equity coverage, which represents a full equity lien because the subject UPB was only $18,607. So you can see right here, the $140,000 figure minus the $98,000 figure gives us $41,327 of equity covering our $18,607 UPB of our junior lien. So our equity coverage here is equity, 41,000 divided by the 18,000 is greater than 1. It's in fact greater than 2. So this is well above a full equity coverage deal. And the combined loan to value, or the first plus the second position balances divided by the fair market value of the home, is less than 1. So it is a full equity from the borrower's perspective as well. So let's dig in a little bit more, talk about the non-performing loan sale value. So we actually sold this loan for $10,500, which represents a percentage of the UPB of 56.43%. Now, if we were going to, if the investor purchased this loan, got the borrower on their original monthly payment plan of $155.67, they'd actually have a 17.79% return right off the bat. Now, this is just here as an example to show you that one potential resolution here could be a modification agreement with no down payment, and they would still earn almost 18% return on their money. But generally, that's not everybody's approach. Most investors want to have a reinstatement or a down payment applied, which would, of course, increase that annual return. So the annual return you can calculate back of the envelope here just by taking that $155 monthly payment times 12 to annualize it, divided by the $10,500 cost basis, with an important caveat that we're not accounting for loan servicing fees. You may expect to pay $15, $20, $25 a month to your loan servicer, which should then be netted out of this payment amount to calculate an actual annual return, unless you are self-servicing, which is not really recommended. Now, a little bit more detail here. Let's talk first about the non-performing loan sale process. So in this case, we produced a portfolio to our downline of note investors with a bunch of different loans on it, and we had a lot of bids from all of these investors, which came in the form of an LOI, a letter of intent with their indicative offers. So all of these investors produced their best offers, and we analyzed those numbers to then decide who was awarded what loans based on the best possible prices. Now, once the indicative process has been approved and the LOI, essentially the letter of intent, has been signed off on for the buyer to go through the rest of their due diligence process, then they really dig in and start spending money on title and credit reports and getting BPOs or broker price opinions for property values to really dig in and understand exactly what's going on. In this case, the portfolio that was sold, that this loan was included in, was sold for $367,000, and it included 21 loans. So let's do a little envelope math here for a potential internal rate of return. We already talked about the 17.79% return if they started collecting that regular original monthly payment, but let's see in terms of whether or not they refinance the loan to actually get a full payoff. So as you know from our previous case studies, I like this internal rate of return easy calculation when I'm not using Excel, and the X-IRR return, which I think is the best way to calculate. Definitely look up X-IRR formula in Excel, but to just do it pretty quickly here, we take the total amount collected, which was $18,607. That's the full unpaid principal balance, assuming that they refinanced the loan and paid off the investor who purchased this debt, minus what they paid, $10,500, divided by $10,500. You may recognize that as an ROI, or return on investment calculation. And then we divide that by the annualized figure, months to exit over 12. Or in this case, let's assume that it was refinanced within a year of purchase, 12 out of 12. So that's a 77% return of investment. And since it took a full year, that's a 77% internal rate of return. So really decent deal here if you were able to refi it at the UPB. This isn't accounting for any arrears or interest payments that may have also been accumulated into the loan. And this is also not accounting for any monthly payments. Perhaps the investor collected that $155 monthly payment for a few months before the refinance. So finally, let's talk about the takeaways here. First of all, this deal was sold as part of a package. I think that's important in a number of different ways. First off, diversification. I think buying a single mortgage note can work out for you, but it's going to be a more difficult process than if you have a number of irons in the fire. That's for a number of reasons. One is because these deals, sometimes we call it hurry up and wait. You get an attorney involved, or you reach out to the borrower, or you send a letter, and then you wait for a response. And oftentimes, if you only have a single loan, you might get a little antsy. You might start doing things in a process that doesn't really make sense. So having a lot of different loans in your portfolio, or at least a handful of loans, allows you to take the actions on each of those loans and wait until some response happens without getting impatient or overly eager on your non-performing resolution process. That's the diversification piece, which is also just important in general. Investing diversification is always critical. Another factor here with purchasing in bulk is you get better pricing. So as you can see on this deal, the percentage of UPB that was purchased was less than 60 cents on the dollar. Now, this deal was sold several years ago, and the market has changed since. We're getting some deals done this month that are going as much as 70 or 80% of the unpaid principal balance for deals just like this, current senior liens with equity, second position loans. So that's another takeaway, is to, if you can, work with bulk sellers to try to get the best possible price. Finally, for your potential internal rate of return, we gave you two options here. One was collecting the original monthly payment and making about an 18% return, 17.79% return on that monthly payment amount. That was one option. Or the 77% internal rate of return if you just collected the full unpaid principal balance, probably through a refinance within 1 year. Now, these are both pretty conservative options, but I think in your pricing process, and this is the takeaway, in your pricing process, you should analyze these lower expectation resolutions. And what I mean is, you don't want to assume that you're going to get a full payoff in 3 months, because then you might overpay for a loan that otherwise could require a little bit more patience. So it's really important when you're analyzing your pricing. So when you're actually making your indicative offer in the beginning of this process, that you think with the end in mind. And you think in terms of, hey, if the borrower started making maybe 50% of their regular monthly payment, where would that leave us on an internal rate of return? Or if we're only able to collect 75% of the balance owed, where are we at there? Now, you can back into a price based on these different scenarios based on what you expect to happen. Now, in this case, the senior lien was current. The borrower was living in the home. It was owner occupied. So we had a strong amount of confidence. The buyer who purchased this loan had a strong degree of confidence that the borrower would come up with some resolution to this debt. They're living in the home. They're paying the other obligations secured by that home. So when you weigh the different potential resolutions of this deal, in this case, the borrower getting a modification or a payoff in place weighs a little bit higher than you going through the foreclosure process and taking back this property to then go through the REO process. So that's it for the takeaways and this case study. Of course, I'll be here for the next one, and we'll be excited to see you then. Leave a comment below with any questions.